If you merged every junior mining company in the world, call it Junior Explorco, one company, right? That company, in a very good year, would lose $2 billion. In a bad year, perversely, they would think it was a good year because they could raise more money. They'd lose, I don't know, $8 or $10 billion. So what's that company worth? Is it worth 8 times losses? 12 times losses?
Welcome back to the Crash Labs podcast, and today I have a very special guest, Mr. Rick Rule. It's definitely an honor and a pleasure, and I know our audience for some time has been bugging me about getting Rick on the pod, so today is a special treat for everyone, especially myself. Rick, welcome to the podcast.
Thank you very much. I should begin by saying I've been a Northern Miner reader for at least 50 years. So
Fantastic.
It's a pleasure to be with you.
Well, likewise. Well, look at Rick. I mean, obviously, it's been a pretty crazy week. We've had a lot of things happening. It hasn't been particularly good for the golds and for the mining space after this election, or at least in the wake of it. What's your feeling on all this? Where are we at? How are you dealing with this week?
I'm still a buyer.
Okay.
You need to have a position to make money in a bull market. So for me, weak markets are the same sort of thing that sales are in physical markets. I'm delighted to have the opportunity to fill out positions in some names where my positions weren't full. Of course, begin by saying that I'm fairly selective, which is to say the fact that some real junk has gone down doesn't matter much to me because I try not to buy junk anyway. But in markets like this, the good, the bad, and the ugly in movie parlance all seem to go in the same direction. And I'm frankly quite grateful for that. I believe that we're probably, I'm no prophet, but probably in the reasonably early stages of a precious metals bull market. And I think looking a little further out, that we have supply shortages coming in a broad range of industrial commodities. So I'm broadly a buyer, which means I'm broadly happy when share prices go lower.
Now, I mean, a lot of our listeners, we often talk about the junior space, the more speculative side of the industry, and I've listened to you speak quite a bit, and I know that, your philosophy's a little bit more anchored into, when money comes back into the space, the first movers will be the index funds and then the majors, of course. And so is that true? Is that a fair assessment that you're looking at more of the large cap end of things from your investment pursuits, or do you invest in the speculative side?
I got pretty full in the large cap names 2.5 or 3 years ago. So that part of my allocation is done. My Franco position, my Agnico position, my Freeport position, that part of my portfolio is done. I always try to stay in front of markets, and I try to stay in parts of the market where other people aren't. If there's lots of competition, it's very, very, very tough to get values. So I'm doing things like courting political risk, going to places that other people are afraid of, uh, going in sectors and market caps that other people don't inhabit. I would point out to you that the strategy that I'm embarking in now requires a lot of work and entails some risk. So your audience will need to determine whether or not the conversation that we're going to have for the next while is suited to them. I've been doing this now for 50 years. In fact, I joke, or more properly, my wife jokes about me. All of the money I now invest sensibly, I made by speculating aggressively. Your audience must determine for themselves what's suitable for themselves.
Well, I always say this to them. I say that I don't know shit about anything, and I'm not licensed to be giving investment advice, so do your own homework. But what I can offer is conversation and some ideas and my perspective, and take it for whatever that's worth, and that's kind of where I like to leave it with them. I think everybody should do their own homework, especially if we're going to be talking about some speculative ideas. But I think that's what people are here for. What kind of discoveries have you made as of recent? Like, what's kind of getting you excited where it's less crowded in the space?
Uh, what I really, really, really like, what's really, really worked for me has been uh, early stage, large discoveries, particularly early stage, large discoveries with obvious warts. So, one example would be the snowline discovery in Yukon. One wart was, of course, that it was and is remote. But another wart had really nothing to do with anything, which is to say, the problem at Victoria Gold. When you have a discovery that you think is at 6 million ounces and perhaps going to 10, high grade ounces. I mean, first of all, if you don't understand why it is selling at a price that appears to you to be cheap, you don't know enough to buy the stock. But if you do understand why it's cheap, and you think through whether or not you're willing to take that risk, that's an entirely different circumstance. So I also like great big deposits in commodities that are out of favor. So, as an example, a rare earth discovery that I think has the ability to be sort of $20 billion in situ recoverable reserves and resources, given that rare earths are out of favor, that interests me. Uh, what I'm really interested in is something that I think is selling for half of its intrinsic value at today's commodity prices. Uh, Something where there is a possibility, although not a certainty, that uh, its worth, its value, as opposed necessarily to its price, will double within 18 months. And where I think I have a chance to make 1,000% on my money, which is to say a 10 bagger over the 5 year time frame. Those are fairly demanding criterion. So that usually means I'm in countries that are perceived as being lousy. I'm in commodities that are out of favor. And the obvious wart that explains the low market capitalization is one that I believe has been unfairly discounted in the share price. Those criterion are very uncomfortable for people. Uh, I would say too that that maybe goes to my investing strength, which is to say I've become extremely patient in my 71 years on earth. Most of your audience, I would suggest, invests or speculates based on very long-term narratives, uh, commodity price narratives, or improving politics, or mine development, or exploration. Their problem comes from employing short term tactics in a long term strategy. If somebody is investing as a consequence of their belief in higher copper prices, and higher copper prices can reasonably expected to take 5 years to unfold, it's odd that investing in a 5 year narrative causes people to be timid about holding stock over a long weekend. That very short term perspective in the context of a long term orientation almost always guarantees failure. And my anticipated holding period is almost always 5 to 6 years.
That's very interesting. To sum that up, I think a lot. I heard a phrase. It was a few weeks ago. We had someone on the podcast mentioned up on euphoria, down on impatience. And I really loved that because it's true. I mean, a lot of names, people like to invest in momentum. They like those euphoric, moments when they can look at their phone or look at their apps and see something they bought last week be up 10 or 15 or 20% or something like that. But as you're mentioning, the fundamental reasons why we are convinced to buy some of these names or make investments has a much longer time horizon needed to sort of manifest that truth, that inevitable truth that that investment's going to come to fruition for them. And they don't have the patience to hold that on. Now, in conversations with others like yourself who have been investing in this industry, a common theme has sort of emerged, which I call it sort of like the sea turtle effect, which is like when I talk to guys like you or Eric Sprott or whatever, who've been investing for so long, it's unbelievable the time horizon that you guys look at investing in this space in particular, and what you would deem as a long-term investment strategy versus a short-term strategy. I mean, many people listening will say, "Oh, a long-term, hold for me is 2 or 3 years," and as you're saying, well, no, 5 or 6 is sort of the starter pack. And I think that's kind of an interesting theme that we've seen.
When I was a young man, and I had a lot of time left on Earth, ironically, I was very impatient.
Yeah.
I would look in the early 70s, albeit with fairly constrained means, at a trade that might buy me four snow tires and a date at a steakhouse. Uh, I've taken care of the need for snow tires and things like that. And it's odd that as I age, as I have less time on Earth, I have much more patience. It isn't though I wouldn't prefer immediate gratification. It's that I've learned over 50 years in markets that immediate gratification is not on offer. Wanting something that has a very low probability of succeeding, uh, you know, it might be interesting, but so what? I look at the folks who in my life have really succeeded, uh, be they company builders like Adolph Lundin or Bob Quartermain or Ross Beatty, be they investors like Seymour Schulich, Ned Goodman, the aforementioned Eric Sprott, Frank Giustra. The common theme is that they build for the very long time. For me, a short-term trade indicates one of two things. One, a mistake. When my reason to own a stock goes away, my stock goes away. So if I bought a stock, as an example, because they were doing a 10-hole drilling program to prove some thesis, to answer some unanswered question, and the first 4 or 5 holes are bad, I presume that the geologist didn't drill his or her worst holes first. And if it is becoming apparent to me that the answer to the unanswered question is no, I sell the stock. If I'm down 30%, I sell the stock. If I'm down 50%, I sell the stock. The second thing that can happen, and it will happen in this bull market, is that you buy a stock in anticipation of them answering an unanswered question that would justify a higher valuation. But the market is so crazy to the upside that the market moves in anticipation before the question's answered. If I buy a stock at a buck because I think some drill holes could give me an answer that'll take it to 2 or 2.5, which would provoke another question, anticipating that in the right set of circumstances, I'll own the stock for 5 years. But the anticipation of the drill holes is so extraordinary that the stock doubles, as an example, before the holes are drilled. In those circumstances, I will certainly sell enough stock so that I have my cash back off the table and I've paid my capital gains tax. I jokingly call that the point of no concern to differentiate it from the point of no return. It's odd that many speculators, when they buy a stock for $1 and they see it go to $2, want to buy more. For me, in the absence of any tangible information, a stock that's gone from $1 to $2 is arithmetically precisely half as attractive.
Hmm. Do you find in your investment pursuits, this is kind of going back to a previous point I thought of the question earlier, when you were describing your sort of workflow and in the speculative world trying to ascertain the relative value of assets, do you find that you need you tend to gravitate towards assets that have in situ resources and, you know, calculus that you can crunch, as opposed to the higher speculative side, you know, pre-discovery or discovery scale end of it.
I do it all. I do it all for a price. Uh, Greenfield's exploration has been very, very, very good to me because I speculate in process. If I'm involved in Greenfield's exploration, at least half of the time, I'm involved in taking big, big positions in prospect generators, people who use their expertise and their acumen to generate exploration ideas, and they use other people's money to focus them. It's the equivalent in horse track parlance of rather than buying one horse race ticket to try and get yourself a bag full of uh, 30 tickets where you only have a quarter of an interest, but you paid nothing. And that's worked extraordinarily well for me. It requires too much patience for most people. But processes work very well for me. If my memory serves me correctly, I've now speculated in over 40 years about 70 prospect generators. And that activity at last count has generated 26 economic discoveries and 23 takeovers, which is to suggest that the probability of success is 1 in 3. To juxtapose that arithmetically to greenfield exploration, it was suggested way back when I was in university that the probability of a surface anomaly becoming a mine was 1 in 3,000. So while the expected success rate in the industry is 1 in 3,000, prospect generators have yielded me 1 in 3. Despite the boredom, that math is too statistically good to ignore. The second thing, I guess, that I've done in greenfield exploration is when the third dimension happens, which is to say, when a drill hole is made, not in anticipation of the drill hole. If I can understand the nature of the drill hole, if I can juxtapose that third dimension with the first two dimensions, sometimes you have to buy the stock. I've seen a lot of occasions where post drill hole, the stock was substantially cheaper at $2 than it had been at 50 cents. You know, at 50 cents, it was a prayer. At $2, it was a prayer answered. And I've been pretty good about being willing to pay up for better information in the exploration side. I guess the third comment I would have with that, and this may be more important than the other two, is that exploration is really an intellectual capital business. It's not a physical capital business. Most exploration properties are an excuse to spend money. That's it. And what you're really speculating on is the resume of the scientist. It really, truly is about the people. Have the people been successful in the past? And have they been successful at the task at hand? Pareto's law teaches us that 20% of the population generates 80% of the positive utility. It teaches us, too, that it's a bell-shaped curve, which means that a different 20% of the population generates 80% of the aggravation in any given task. So as a speculator, your first job is to identify and hang out with the good 20 and identify and pass on the bad 20. What gets more useful is that both the good lip and the bad lip, if you run them through the same performance dispersal curve, conformably align, which is to say that 20% of the 20% do 80% of the 80%, or 4% of the population base generates 65% of the positive utility. What I've learned after 50 years on the racket is that there's at least one more positive correlation, which is to suggest that 1% of the people in the junior mining industry generate 40% of the utility. If you identify those people and just hang out with them, just by their deals. Pass on any other noise, any other temptation. You'll work a quarter as hard and make twice as much money.
So I've sort of reviewed that concept, and I can't seem to untangle if it's because those people are good at geology and good at their job, or if it's because they're just better at raising money. And I'm almost looking at it as in, you know, he or she who can raise the most money in the exploration game, particularly in greenfield exploration. It's a 1-to-1 success ratio with, you know, you spend more money in the ground and you will likely have more tangible results come out. Now, you know, is that the tail wagging the dog? Is that, you know, a result of these people being tremendous, or is it because they can simply raise more money? And I guess some examples I'll give is that if you take, you know, for example, Barkerville was an interesting junior company, and they had spent a reasonable amount of money exploring, and they were, you know, making, struggling to keep this story, keep it relevant, et cetera, et cetera. There was Cow Mountain. There was all of these bizarre things, and these kind of not so impressive zones, but they had other things like Bonanza Ledge and all these other kind of showings on the project. But this is a massive district. And then when Sean Roosen came in, I think they spent $80 million pretty much out of the gate, which was probably the equivalent that the previous group had spent over the course of, you know, 5 or 6 years collectively, if they spent that much. And suddenly you've got real ounces being discovered, real inventories. And today now, I think officially they're about ready to get mining on this thing. But, you know, it's sort of this phenomenon, or I mean, very similar to what happened at Windfall Lake, right? You spend money, you find out, and you can take something or a project that has the geological potential, but if you can't spend enough money drilling it, you can't stitch together the ounces, you can't move the story forward. And so I often look at projects and wonder, you know, at least in my investing pursuits, can this person tell this story and captivate enough people to raise money? And you're right that there's serial success cases. The people that have past success will have an easier time raising the capital. And I tend to follow that to some degree. It has a high weighting in my rank order of feature importance when it comes to junior investing.
The kind of people who, were it not for junior mining, when they went into a 7-Eleven, would likely go in with a mask and a gun.
Okay.
There are a group of people who have been serially successful, and I would suggest that they enjoy a positive feedback loop. A very successful financier, say a Ross Beatty, can hire great people because those people know that they'll get to work on great projects. Great geologists and great engineers like to work for great geologists and great engineers. And when a prospector has a superb prospect, rather than turning that prospect to the lame, the halt, and the blind, their first call will be to Ross Beatty. So the good work will get done on a great project. When somebody is looking around for seed capital, and you know they call some tough old investor like Rick Rule. If Ross Beatty makes that call, he's going to get a call back. You know, and then the quality of the work that gets done by these high quality people. It isn't just that they have high quality people evaluating the projects, they have high quality people getting the work done. When the time comes to acquire less risky, less sophisticated capital, you know, when the time comes to move up the feeding chain, Ross Beatty and his ilk enjoy a lower cost of capital as a consequence of their past successes. So I would suggest it's all of the above. If you look at Sean Rosen and his team, I'm not, you know, Sean, who's a good friend of mine, would object to the success enjoyed by Sean Rosen being all attributed to Sean Rosen. he would suggest correctly that his team had a lot to do with it,
Yeah,
not with
yeah,
mine.
no, likewise.
But if it comes to me from a Bob Quartermain or a Stephen Dean, who also, by the way, really liked Windfall Lake, Sean beat him to it, uh, or the Lundin family or Robert Friedland, the consequence of their past successes means that very high quality people work for them, that they get shown very high quality projects, that they enjoy a lower cost of capital, and they have better instincts as to how to progress in different market climates because they've been involved in the game for 30 or 35 years. The truth is, like every other human endeavor, it's not fair.
No, it's not fair.
You
Yeah.
know, people were talking to Buffett once about how he invested. And he said, if you own a basketball team, the first thing you do is try and buy a couple 7-footers because the pygmies don't make many points. And there's a lot of wisdom there in junior mining. Most of the players in junior mining are pygmies or sub pygmies. Uh, there's a few 7-footers. Identify them, they stand out, and stick with them.
Stick with them. I think that's good advice. Now, do you think that on average, I mean, there's always the outliers, right? There's, Scott Birdall, for instance, a good example with Snowline, and Scott's been on the show. And obviously, humble beginnings, prospector family, had this thing, and he waded
Yep.
into this big fish world of capital and capital raising and drilling and headlines and attention. Myself, even with Newfound Gold, it's very similar, you know, unknown quantum, and then kind of came in and got to enjoy some tremendous success with that. But in the case of Scott, he took this on. But one of the things I noticed is that there's very few discovery stories today that managed to get out of, like, from those outliers. A lot of people are fixated on these tiny raises and diluting their shareholders, and I want $1 or $2 million to do this next season. What's your perspective on that? Do you feel like that's just inadequate capital in today's market, and that drilling is more expensive today and operations? And do you think that the starter pack, so to speak, of what people at the early grassroots stage of financing, chasing a dream, is the bar too low for them?
I think that much more rationally should be done privately. Uh, Here's a really stunning statistic. We had a young intern, financial services speak for slave, uh, 25 years ago, and we had him select 25 what were then VSE companies, now TSXV companies, at random. Look through the balance sheets and the financial statements for 5 years and see what trends he came up with. And I actually wasn't trying to find out anything, trying to find out how the young guy thought. And he calls me and says, "Okay, I got it." Well, that was interesting because there was nothing to get. I said, "What did you get?" He said, "Well, the median of 25 companies, albeit randomly chosen, was that they spent over 60% of capital raised on G&A, meaning less than 40% went in the ground. If you and I established a joint venture with a major mining company and we were going to spend 2 million of their dollars, they may give us a 12% G&A allowance. If they really liked you, they'd give you 12. But the junior capital markets traditionally load these things to 60%, which doesn't work. There are, in my case right now, probably 10 juniors that I'm looking at that have sub 5 million Canadian market caps. But at some point in their history, they had 60 or 70 million market caps. They've spent 30 or 40 getting to where they are, and the market assigns them sub 5 valuations. What I'm really doing is I'm buying 40 or $50 million worth of work for $3.5 million. In those circumstances, I'll be happy to put up be part of a million and a half dollar raise, because there is so much definition on the project that I know that an unanswered question can be answered positively or negatively for a million and a half with only sort of 350,000 going on G&A. The juxtaposition between dollars in the ground and general and administrative expense is extremely important to me.
Hmm. So do you fear the sort of sunk cost fallacy with any of that? Which is like,
My anticipation is failure.
right.
Anybody who is a good speculator understands that he or she is going to make more bad decisions than good decisions. If you are psychologically or financially unable to deal with that, then buy Enbridge or AltaGas. Do something sensible with your money. The arithmetic around speculation is that a 10 bagger or a 20 bagger amortizes a lot of 25 or 30% failure. And that's just sort of how I go. The arithmetic is wonderful. That's one of the reasons why I like warrants so much. Warrants turn a 10 bagger into a 15 bagger, and a 15 bagger amortizes a hell of a lot of bad decisions. They weren't stupid decisions, they were decisions that were taken understanding that most decisions in exploration end up being wrong.
Do you ever invest in a company that does not offer a warrant
I have.
in
Uh,
like a junior deal?
yeah, I have. The truth is that the industry describes itself as being undercapitalized, which is horseshit. It's stupidly overcapitalized. And the fact that so many companies are able to attract exploration finance without a warrant tells me that the industry is stupidly overcapitalized. Sidebar, I've probably participated in 20 private placements in the last 2 years, and I would suggest that at least 15 of them were oversubscribed and that I got cut back. So I hear about this industry that's starved for capital, and I see terms being offered to investors that are, in the historical context, um, insanely unattractive, albeit good people and good projects. And despite the fact that the industry believes itself to be really, really, really undercapitalized, I get cut back. I'm not the only guy. Jonathan Goodman gets cut back. Eric Sprott gets cut back. The whole range of us do in high quality projects. The industry is not undercapitalized.
Hmm. Now, do you think? Okay, so I think we would probably. I would agree that in some respects it's not undercapitalized by those measures, but I'm also cautious that I know that the cost of exploration and what can be achieved with capital today is dramatically different than what was achievable in 2014 or 2011 or 2010. By my recollection, I think you get about 3 times. You got your dollar went 3 times further. I think in those days, and if I can roll back the clock to 2008, I feel like $1 million got me a lot more drilling than it does today, and that's probably wrong, but I've got that sense now. Obviously, with things in Canada on the Canadian landscape, charitable flow through, there's been some legislation that's been put through that's sort of stymied some of the inflows of capital vis-a-vis flow through, charitable flow through, which, I mean, arguably many didn't like those facilities anyways and didn't think that was healthy for the market to be getting that type of subsidy, I guess you could call it. What are your thoughts on that? Do you think that there's going to be a vacuum in capital thanks to some legislation on this, or do you think there's still ample supply? I mean, you mentioned already that you think that the market's not underfunded in any way.
I think the market's overcapitalized. Um, if you, this will not be popular with your sponsors, your issuers. If you merged every junior mining company in the world, call it Junior Explore Co., one company, right? That company in a very good year would lose $2 billion. In a bad year, perversely, they would think it was a good year because they could raise more money. They'd lose, I don't know, $8 or $10 billion. So what's that company worth? Is it worth 8 times losses? 12 times losses? In a good market, is it worth 15 times losses? What's the price loss ratio? Look at the money that has gone in the ground as a proportion of total money raised. It's a effing scandal. Once you get past that scandal, look at the economic returns, the projects that have gone into production, or the companies that have been involved in M&A and gotten sold. Look at cash into the sector and cash out of the sector for the last 40 years. It's a disgusting picture. Now, that cover statement obfuscates sometimes the fact that the best 5% of issuers have generated so much performance that they've added legitimacy and sometimes even luster to a sector that characteristically loses between $2 and $10 billion a year. If you invest in the sector as a sector, one of the few guarantees in the investment business is that you will go broke.
Right.
Absolute guarantee.
Yeah, that's true.
You need to understand that you need to work very hard and think very hard about how you defy the odds in the sector. I think an industry that is able to continue to raise money in the face of scandalously high general and administrative expense and has been able to do so despite ludicrously poor sector-wide investment performance over 40 years, to the extent that that industry can raise money at any time, it's overcapitalized.
Now, what role do you think the seniors play in the perspective of generalists as they look at this industry? Because obviously, I agree with you en masse. If we lump all the juniors together, the index performance is atrocious, and some of us feel the confidence and the experience to know we can, outpick that index. But I mean, we've also got a team of geologists and people that have been doing this for a long time. Now, the majors sort of taint this picture as well, or at least add to it. What are your thoughts on that?
I think the majors are getting better. They used to be indifferent investors at best, often doing strategic investments, and often, frankly, merely investing in people who were their friends. I think they've gotten much better. I think the majors understand, particularly in countries that isn't their primary domicile, where they'd like to go in. As an example, a Canadian company that wants to go into Argentina, a Canadian major, would find that just setting up an office is $1.5 million. If they can invest in a project generator in Argentina or in an Argentine project for $1.5 million, it's free money to them. They would have spent that much money getting in country. You find companies now that are really following probably the lead established by tech, where they understand the juniors as off-balance sheet financing, where they will make projects available to companies. They will joint venture with companies. They will invest in the companies. I, as an investor, really, really, really like to involve major mining companies, either as an investor or a joint venture partner. When I walk through, as I did a couple of years ago, BHP, and I see a company that has 300 earth scientists, some of whom are focused on the same project as me, where I don't have to pay for them. That gives me a lot of solace. And by the way, they're not consultants. After they've looked at a project, they don't send me a bill. They write a check. That's a very honest process. So having Agnico Eagle as a bed partner, having Teck as a bed partner, having Rio or BHP as a bed partner, no guarantee of success, but I got to tell you, it makes me feel a lot more comfortable.
It feels like maybe a bit of a bellwether here too, because I can't remember a time when I saw the activity amongst majors engaging with small cap juniors, scratching the size of checks that they're scratching. The joint venture aspect doesn't surprise me because it was a bit of a flawed model in the sense that, like, a lot of companies at the tail end of the last bull market were sort of somewhat sterilized by partial asset ownership or earn-in structures or joint venture structures that were sort of a on the capital side seemed like untouchable at sometimes, like with these 60-40 splits and bizarre structures. But now you're seeing a lot more discretionary investing from these large companies and getting involved for 10, 15, 20% in these minuscule companies. Does that tell you anything? Am I wrong to say that this is I feel like it's the first time I've seen it since probably being active in this space since 2005. Is that a thing?
I think you're right. I think that the majors are looking at, in some of these juniors, the culmination of 10 or 15 years of effort. And they're buying data at what ends up being a 20% discount to what's been expended. The majors have the ability, not always successfully, but the ability in movie parlance to segregate between the good, the bad, and the ugly. They're competing with capital markets where the punter's technique has got a hunch, bet a bunch, and it's not a fair fight, which the majors recognize.
Now, do you think the majors have sort of turning this over to the broader generalists and stuff? Do you think? I mean, I've heard the comment that majors, in terms of their production and performance and guidance and exceeding, meeting the market's expectations, has sort of let people down. Do you think that they've? I mean, many have levied the charge against them that they've done this industry a tremendous disservice as our sort of front line to external markets and generalist communities and other investors. What are your thoughts on sort of the majors and their performance on the operational front and how that sets the stage for people to have confidence in resource investing?
You need to segregate by major. And I think, too, that the investor, in particular the institutional investor, needs to accept some of the blame. You either, as a top line statement, can emphasize cost efficiency, or you can emphasize optionality. You decide that what you're going to offer up is near-term optionality to the commodity price. You are by nature less operationally efficient. It's the high-cost producer, the high-cost marginal producer, that generates the best margin increase in the face of higher commodity prices. So institutional investors in particular need to be very careful what they ask for. Let's look too at something else. Let's look at Newmont just for fun. Newmont has disappointed for 6 straight quarters. And I think that Newmont has identified their problem. First of all, in the construction of Newmont, if you look at all the companies that went into it, it became a sort of an amalgam of tier 2 mines. Then they acquired Newcrest. If you operate as many mines as Newmont operates, the idea that you can lavish enough love, care, and attention on 5 of them to make a difference is sort of a non-starter. What Newmont has said, and I hope they do it, is that any deposit that doesn't meet their tier 1 criterion will be sold. This is a good property market. They will use the proceeds to strengthen their balance sheet, which needs to happen. More importantly, as opposed to trying to operate 17 or 18 mines, they'll be operating 5 or 6. They can lavish the same love, care, and attention on those projects that Agnico Eagle does. What a lot of punters don't recognize is when you have a very large deposit that you come to know well, the return on capital employed in optimization can be off the charts. It might be that the overall return on capital employed for a big mine like Malarctic is at a given commodity price 25%. But marginal improvements, changing out shovels for more efficient shovels, or upgrading the size of the haul trucks, or tweaking the mill, uh, those incremental investments can generate 100 or 150% returns on capital employed.
Sure, absolutely.
That's what changes the nature of corporate proficiency. And that's what also gives companies the ability to meet or exceed guidance. Of course, conservative guidance to begin with, and a culture that emphasizes intelligent guidance is useful too.
Now, I don't know what you think about this, but I'm curious to get your thoughts on this piece. But I've been, I spent the first decade of my career on the operating production side, so I've chased that carrot far too long to talk about, I have fond memories of those days, but I also have a very, very clear memory, and it almost still gives me anxiety when I think about it. Having a goal and then reaching that goal, and then the carrot is always dangled that little bit further, and whether it be throughput or grade or whatever it may be, always pushing forward. And so I could only imagine what happened in 2014 when prices plummeted and the sensitivities of these operations were earmarked around $1,400-$1,500 prices, and we're looking at $1,100-$1,200 prices. And suddenly we see the cost per ounce go down. The all-in sustaining, the AISC costs were down to like the 900 range. And this was like, for a lot of people that are going, well, they could have done that all along. But what they were really doing was high grading the snot out of these deposits. And then they had to do this until from 24, I'll say between 2013 straight through to about 2017, 2018, this was the case. And then prices kind of came back in. But then what happens is you're not going to get back. So now, we're looking at $2,600 gold and going, where's all the free cash flow? Aren't these guys, and we're seeing these AISC costs rise. And I go, well, yeah, they're catching up. All of the low grade and medium grade ore that they had to set aside and leave alone to strictly focus on high grade so that they didn't implode totally. Now they're going back and mining, and it's quite a bit more expensive to do that. But why wouldn't you do that? You have to catch up. And then a lot of the times too, they're putting out these resource updates of, that they've replaced, I think it was forget who, anyway, one of them announced recently that they had grown their M&I resource base by 10% over the quarter. And it's like, well, yeah, if you remath your stuff with higher sensitivities, you'll include more material. And so you don't see the grade jump up dramatically with that, but you're converting things that otherwise weren't part of the mine plan into the mine plan. So there's a bunch going on here. So I guess, do you think that's a fair assessment, that there's going to be some catch-up time in mining the low grade and the left behinds of the past decade, let's say? And how long do you think till they catch up, and then we actually do see those AISC costs go down, and then the blend of material being higher grade and seeing that free cash flow?
I don't know the answer to the second question. I wish I did. Uh, what I do know, one of the things that I follow myself on a quarter by quarter basis is the juxtaposition between the average grade mined and the average grade in the reserve. If you find a company whose reserves average a gram, and you see for a quarter or a year that they're mining 1.3, it tells you that in the out years they're going to be mining 0.8. Variance, and some companies, by the way, when they report depletion, they report depletion on a tons basis rather than a product produced basis. In other words, they don't adequately account for the material depletion of the ore body. but rather the aggregate tons depletion in the ore body. I actually think that's fraudulent, but I guess fraudulent implies illegal, and it isn't illegal. But when I see a company where there's been a substantial discrepancy between mined grade and reserve grade, particularly where I don't see an increase in depletion charge, I get very, very afraid. For the reasons that you described, you've taken the eyes out of the deposit. And you necessarily are going to be spending the same or more money mining material that is of substantially lower grade. I mean, a better circumstance, I think. Well, let me rephrase that. Uh, I won't name this entrepreneur, but I know an entrepreneur who sort of runs a multi-mine company, and he was telling me that he visited one of the mines in that portfolio for the first time in a couple of years. Walked in and he saw a haul truck, and his quote was, "The effing thing belonged in a museum." And he, on the spot, said, "I'll work this out with the board." He, on the spot, authorized a $9 million replacement. That one investment brought down the AISC. He, I guess, had defaulted too much to his financial staff, who had suggested that the old haul truck had X amount of life remaining on a unit of production basis, and his response, seeing the thing, was, quote, "It belongs in a museum."
Jesus. Well, that's interesting because I know during the COVID days too, and I was talking to, and I won't mention the major companies, but I was talking to one in particular that maybe we may have mentioned earlier, and they were mentioning with all of their replacement how hard it was to get new gear because of the backlog and the supply chain issues, like Caterpillar and all of these other companies, the suppliers. They were on Ritchie Brothers trying to shop for used stuff and sell or if they got a new thing, they'd sell the new thing because anyway, it was crazy. Like just the unbelievable game they had to play for 2 years, 3 years. So I can only imagine, now that everything's coming back to normal and prices are where they are, there's got to be some amount of catch up, clean up, updating required, etc. So.
I think you're
Geez,
right.
I
I was
hope that
on
soon
Lindsay.
they can revel in the free cash flow that everyone expects them to get at these prices, and
I
they
remember
can keep their costs in check.
Don Lindsay in the last boom telling me that somebody tried to deliver a haul truck to him without tires.
Oh wow, really?
Yeah.
Yeah. Anyways, so truck falls off the wheels. Well, let's hope. Hopefully, our wheels don't fall off our truck this this year.
I honestly think this is going to get better and better. All of the bitching I do,
Yeah.
I think
Is anybody listening?
disguises. Well, that's one thing. The audience is much bigger than people think it is. The audience that you all have managed to acquire. My own audience has grown, uh, I guess, since 2012 from zero to 92,000 double opt in subscribers. There is a much larger audience now than there
Wow.
used to be. The,
Congratulations.
the capital markets people are old and fat and lazy. Uh, in religious parlance, they tend to pass the collection plate through the choir rather than making the congregation bigger. I notice in terms of my own data acquisition that well over half my audience now, in terms of the new responders, not the gross audience, but the new responders, more than half are under 40. 35% are female. I've never seen this in the business.
Really,
So the
45%
audience
female.
the audience isn't merely growing, the audience is growing rapidly. The industry, when they go for capital, it goes back to the usual suspects. They go for old, fat, bald, white guys like me because they've talked to them for years and they know how. And they're missing this gigantic audience out there because they don't talk to them. That is a problem. I think, and I think that when I say it's a problem, I think it's an opportunity. That's really what I think it is. The second opportunity, I think, is that those few remaining institutional investors in the sector got their chops busted last cycle. And I think that they're going to keep mining company managements on a much, much, much tighter leash. I'm starting to hear in conference calls this wonderful phrase that says the investment must be accretive on a per share basis. Otherwise, we'll buy back shares. I mean, this seems like a really, really, really simple metric, but the game used to be grow at all cost. And it turned out that the costs were worth more than the growth. Uh, so I'm actually feeling pretty attracted to things for the next 5 years. I also think personally that we're going to benefit because the commodity price is going to be on our back. We haven't had that for quite some time, and we can talk about that if you like. But both with regards to precious metals pricing and industrial materials pricing, I think we're coming into a very, very permissive time. If you come into a permissive time like that, where your investor audience is expanding, and you don't realize it, and where there are some newfound efficiencies, some discipline, uh, you have the possibility, I think, for a stealth bull market of proportion that people aren't aware of because people are rear looking.
Well, do you think it would attract a different type of person too than what would normally follow the reverse order of
I'm,
prices
I'm
as on the
already
speculative front
attracting
end?
them. I'm,
Yeah,
not could. This is happening.
it's happening. Yeah,
Look at me, 71 years of age. I'm not attracting these young women because of any physical attraction, right?
sure. Yeah.
This is intellectual attraction, and this actually happened to me accidentally.
What's your wife
In
think about all this?
She's good. She's good. Uh, I back in about 2012, when I was still with Sprott, Eric and I and some others were talking about the fact that our audience was literally dying, not figuratively dying. Uh, Investors who came of age in the 1970s and they were shedding their mortal coil. So the question became, how do we find a new audience? And we talked about this lots. Meanwhile, uh, I, and to a much lesser extent, Eric, began experimenting with social media uh, as a way to reach our existing audience without the filter of financial media and the investment banks. We were looking for debottlenecking the flow of information from ourselves to our audience. As we became more adept at social media, an audience that we didn't know existed found us. We went out and found younger people where they were, not where we were used to finding them. I think that I think that message is lost on the industry, particularly the junior industry. When the junior industry needs capital, they call up Canaccord, they call up Haywood, and in movie parlance, Canaccord or Haywood tries to round up the usual suspects. The usual suspects are old, dead, and at least partly broke. There's a whole range of people out there who are very, very, very interested in our industry, in our topic. We need to find them. They want to talk to us. We need to engage them in their language, not ours. And we need to teach them how to mobilize their capital intelligently so they don't make the same mistakes that their predecessors did.
Well, like you, I've got a keen interest on the social media aspect of that, and trying to undertake that very thing, and that's sort of the MO of what we're trying to put together here at Earth Labs with rolling up the media side,
You guys,
mining.com, Northern
you guys are
Miner.
killing it. You're
Yep.
absolutely killing it.
Well, I really appreciate that. And viewership's up 160% this year. Just to echo kind of what you were saying is so the traffic we're seeing on average across all platforms is up 150, 160% this year alone since January. So it's a really fascinating. What am I attributing that to? Is that because we're doing a good job? I don't know. Is that because just that many more people are interested and are hearing your message and are getting more interested in this space? I'm not sure what to attribute that to, but it is definitely something that we can touch and feel and measure these days.
I mean, that's a big number. It's a big number in particular because your starting base is so large. Uh,
Yeah.
if you look at my percentage increase, it's impressive until you realize that I started at zero.
Well,
But
that's phenomenally impressive.
impressive gains from a statistical base that's as significant as yours is no small achievement.
Yeah, no, it really is. It really is quite telling. I think, I geez, I wonder though, and I'm really glad that you've taken to social media and taken this approach as well, because and I think it's a matter of time, and hopefully we can help chaperone people through that. But the medium that this new crowd that we're trying to target as an industry is a younger crowd, and they don't want to read the same type of stuffy press releases and annoying PowerPoint presentations and all of this stuff. It's just driving them crazy. Well, they're never going to pay attention to that ever.
They're going to have to. I tell anybody who cares, and a lot of people who don't care, that the number of stocks that should populate your portfolio is directly related to the number of hours per month that you're willing to work. In other words, if you're willing to spend 10 hours a month reading 10Ks, 10Qs, proxies, resource statements, not listening to blogs, an hour per month per company in your portfolio. The big mistakes that the youngsters are making is the same mistake that my generation made. Their speculative technique is got a hunch, bet a bunch. Uh, and if they don't begin to consume long form content, if they don't begin to study securities analysis and credit analysis, if they don't read insider reports, if they don't look at income statements and determine what proportion of capital raised went to G&A, they will suffer the same kind of investment performance that their fathers did, which is to say, really, truly, profoundly shitty.
Mm-hmm. Yeah, super shitty. Now, I think the onus is also on the issuers too, on the issuer side, to do a better job communicating with these people in the format that they need to be communicated with. They don't have the attention span that.
Here's a wonderful example. I just had Sean Boyd, ex CEO, now chairman of Agnico Eagle. The company is going to deliver probably 5B in EBIT this year. He came to my conference at Boca Raton, Florida, a retail conference, and he sat on the floor and he talked to people that had 500 shares or 600 shares or 700 shares. He participated in the educational section, which is to say, this guy put himself out for shareholders. I've noticed for years at my conference, the most successful people are the most accessible, that work the hardest. I watch, Ross Beatty at the end of a conference pack up the promotional materials that were unused, while people who had companies that were nowhere near as successful threw theirs away. Uh, there's a lesson here, this sort of culture, what you suggest. If the CEO is interested in his or her cost of capital, they have to learn to build a constituency. They have to learn to teach that constituency. They have to learn how to communicate to that constituency. It's critically important. This old thing where somebody calls up Canaccord and says, "Raise me $1 million." I mean, yes, it'll still work, but that's not where the game is over. You need to do like Amir Adnani has done,
Sure. Yeah, Amir's done a fantastic job of that with the uranium, the
where you
uranium stuff.
build a private constituency of 120,000 people that you communicate with, so that you have a source of capital when your competitors don't, so that you have an audience that's predisposed to react to good news.
Well, I could actually add one further than that, Rick, because I think even 160,000 people is huge and is far more than is necessary to be effective. I think if people built a constituency of 160 people, I mean, we can see the statistics. When you have a group like that, even if it's a couple of hundred passionate investors, it's night and day, especially for the small cap names. It's night and day what they can achieve.
Yep.
Their stock performs better, their raises go smoother. You can literally see it's a night and day difference. And you can like we can see because we have a lot of clarity on the various CEO.CA channels and how many people are looking at those channels and what the engagement time is and what their open rate is on their press releases, et cetera, et cetera. And some of this sentiment data is very valuable. But one of the things that jumps out is you can see when these groups are able to foster, as you say, a constituency, and even if it's like a couple of hundred people, it's phenomenal what that can do. And CEOs really need to make that a priority.
If you guys ever do an issuer seminar, I'd love to be part of it.
Oh, I'd love it. It'd be awesome. Yeah, that's a good idea. Well, I think that about wraps up. I mean, look, Rick, we could go on for hours. I think there's a million things we could talk about. What are you up to now, and how could our investors find you? And with Battle Bank and all these good things, do you have anything on the agenda on the horizon here?
Three things I'd love to talk about since you gave me that broad license. I'm celebrating retirement by starting a bank, Battle Bank. This is the seventh bank I've had deep familiarity with. Some of your American readers will probably remember our last bank, Everbank, which we took from zero to $28 billion before we sold it to TIAA CREF. So we're building a new bank. If for any reason you're unhappy with your current bank, I suspect that's everybody in your database. Check out battlebank.com. Uh, the second thing I'm up to is Rule Investment Media, really an investor education business, not unlike your own, although not with a subscription basis. The easiest way to get involved with Rule Investment Media, if you like what I have to say about natural resource investing, is go there, ruleinvestmentmedia.com, list your natural resource stocks, and for free and no obligation, I will personally rank them 1 to 10, 1 being best, 10 being worst. If I believe I have a comment that may be of use with regards to one of the issuers, I will in fact comment. While you're there, check out the Rule Classroom. We have over 200 hours of instructional programming and interviews at the Rule Classroom. It's all free. That way, I guarantee, of course, that you'll get your money's worth. Now, we also have products there. Once every 90 days, we do a deep dive into one topic around resource investing. When I say deep, I mean 8 hours online. Uh, we did uranium, we did silver, we did prospect generators, we did royalty and streaming, we did the capital stack. We just did tier one deposits. This is not a place for tourists. We work you very, very, very hard for 8 hours. We make the recordings available for a year because our belief is that you'll have to play the recording 4 times before you really truly will have gotten your money's worth, which is to say you're going to have 30 hours in that lesson. Like every investor education product I've offered up for 28 years, these boot camps, and of course our wonderful live conference in Boca Raton, Florida, come with 100% no questions asked money back guarantee. If you don't think for any reason you didn't get your money's worth, just email me. I'll give you the money back. Now, I'm delighted to say that in 28 years of offering money back guarantees, I've had to refund about, well, actually less than 0.1% of the money that I've charged. Uh, with
That's
that said,
ecstatic. That's exceptional. Sorry.
yeah,
Fantastic.
with that said, don't come to the boot camp if you're a tourist. If you aren't really willing and able to work 8 hours or really 30 hours, including replaying the recordings, don't come. It won't be worth your while.
I could pick your brain for hours about the psychology of the types of people that attend the boot camp and what their collective ideas land on,
What I'd love
particularly
to
on your
do,
survey.
what I'd love to do, if you get enough response from this interview that you think it's worth your while, is at some point in time talk you through my precious metals case, talk you through my conventional energy case, and talk you through my industrial materials case. I think after 50 years in the business, remember, I'm not a guy that was a tech guy that became a pot guy that became a crypto guy. I'm a resource guy and a conventional service guy from day one. Uh, to the extent that people had an interest in my view as to the structure of these markets, I'd love to have that conversation if you thought it would be worth your readers' while.
It's 100,000% worth our readers' while. So we'll have to have you back. We'll schedule it up, and we'll be learning about each one of those categories with Mr. Rick Rule. Fantastic. Thank you so much, Rick, for coming on the show today. It was really a treat having you, and I hope everybody listening really loves this. And we'll have to get Rick back on and talk some more.
I look forward to it. And by the way, I should tell your listeners in the UK, I will be speaking at the Northern Miner Conference in London in December. So if you're around, do your personal balance sheet a favor and show up at the conference.
Perfect. Well, thanks for the plug. Amazing. Thank you, sir. Take care.
Thank you.
Cheers.